There is a tax rule that exists specifically to help American retirees save thousands of dollars on their home, and the overwhelming majority of retired Americans have absolutely no idea it exists. The IRS has a provision that could legally eliminate or dramatically reduce the taxes you owe when you sell your home, and yet most retirees either never hear about it, misunderstand how it works, or miss the deadline to take full advantage of it. If you own a home and you are retired or approaching retirement, what you are about to learn in the next few minutes could literally save you tens of thousands of dollars. So please watch this entire video because the details matter enormously, and one small mistake in understanding this rule could cost you a fortune. Welcome everyone to SSA Benefits Alert, your most trusted source for Social Security updates, retirement benefits news, IRS tax rules, and everything that affects the financial lives of retired Americans. Whether you are already collecting Social Security, still working and planning for retirement, or somewhere in between, SSA Benefits Alert is here to make sure you never miss information that could protect and grow your retirement income. If you are new to this channel, please subscribe right now and hit the bell icon so you never miss a critical update. And to all our loyal viewers who come back to SSA Benefits Alert again and again, thank you so much for your continued support and trust. It genuinely means everything to us and keeps this community growing every single day. Now let us get into one of the most overlooked and most valuable tax rules available to American retirees right now. The rule we are talking about today is officially known as the Section 121 exclusion, but most tax professionals simply call it the home sale tax exclusion. Here's the basic idea. When you sell your primary residence, the IRS allows you to exclude a significant portion of the profit from your taxable income. For a single filer, that exclusion amount is up to $250,000 of profit. For a married couple filing jointly, that exclusion jumps to up to $500,000 of profit. This means that if you are a married couple and you sell your home for a profit of $500,000 or less, you could potentially owe absolutely zero federal capital gains tax on that entire gain. Zero, nothing. And yet survey after survey shows that a shocking percentage of retirees either do not know this rule exists or do not understand how to qualify for it correctly. Now let us talk about the qualification requirements because this is where many retirees make costly mistakes. To qualify for the full Section 121 exclusion, you must meet two tests. The first is the ownership test and the second is the use test. The ownership test requires that you have owned the home for at least 2 of the 5 years immediately before the sale. The use test requires that you have used the home as your primary residence for at least 2 of those same 5 years. Both tests must be satisfied, but the 2 years do not have to be continuous and they do not have to be the same 2 years. You could have owned the home for 3 years, rented it out for 1 year, lived in it again for a year, and you would still potentially qualify as long as the total time adds up correctly within that 5-year window. This flexibility is something that many retirees and even some tax preparers do not fully understand. Here is where it gets particularly relevant for retirees in 2026. Many retired Americans are in a position where they are thinking about downsizing, moving to a warmer state, relocating closer to family, or simply pulling the equity out of their home to fund their retirement years. The home sale tax exclusion is perfectly designed for exactly this situation. If you have owned your home for many years and it has appreciated significantly in value, which is true for millions of American homeowners, after the dramatic rise in real estate prices over the past decade, the profit on the sale of that home could be enormous. Without the Section 121 exclusion, you could be looking at a very large federal capital gains tax bill, potentially at the 15 or 20% long-term capital gains rate depending on your income. With the exclusion properly applied, a married couple could shield the first $500,000 of that profit entirely from federal taxation. Let us put some real numbers on this to make it concrete. Imagine you and your spouse bought your home 25 years ago for $200,000. Today that home is worth $700,000. If you sell it, your gross profit is $500,000. Without the home sale exclusion, assuming a 15% long-term capital gains rate, you would owe $75,000 in federal taxes on that gain. With the married filing jointly exclusion of up to $500,000 applied correctly, your entire gain is excluded, and your federal tax bill on the sale is zero. That is a $75,000 difference, and that is money that stays in your pocket to fund your retirement. Now, there are some important limitations and special circumstances that every retiree needs to understand to make sure they are applying this rule correctly. First, the exclusion only applies to your primary residence. It does not apply to vacation homes, rental properties, or investment properties. If you have a second home that you are thinking of selling, the Section 121 exclusion will not protect those gains unless you convert that property to your primary residence and meet the ownership and use tests, which takes careful planning and time. Second, the exclusion applies to federal taxes, but it is very important to check the rules in your specific state because some states have their own capital gains taxes, and the state rules may differ from the federal exclusion. Third, the exclusion can only be used once every 2 years. You cannot sell one home, use the exclusion, buy another home, sell it a few months later, and use the exclusion again. There is a 2-year waiting period between uses of this exclusion. There is also a very important concept called the basis that every homeowner needs to understand before calculating their potential gain. Your basis in your home is not simply what you paid for it. Your basis includes the original purchase price plus the cost of any capital improvements you made to the property over the years. Capital improvements are things like adding a room, remodeling a kitchen, installing a new roof, adding a swimming pool, or making other permanent improvements that add value to the home. These improvements increase your basis and therefore reduce your taxable gain when you sell. Many retirees forget to account for decades worth of home improvements when calculating their gain, and as a result, they overestimate how much profit they have made and therefore how much tax they might owe. Keep records of every significant home improvement you have made and share them with your tax professional when the time comes to sell. Another situation that affects many retirees specifically is what happens when one spouse passes away before the home is sold. When a spouse dies, the surviving spouse receives what is called a stepped-up basis in the deceased spouse's share of the home, which means the basis for that half of the home is reset to the fair market value at the date of death. This stepped-up basis can dramatically reduce the taxable gain when the surviving spouse eventually sells the home. Additionally, a surviving spouse who sells the home within 2 years of their spouse's death may still qualify for the full $500,000 married couple exclusion even though they are now filing as a single person, as long as they otherwise meet the ownership and use tests. This is an incredibly valuable provision for widows and widowers, and it is one of the most frequently missed rules in the entire tax code. There is also an important partial exclusion available for homeowners who do not meet the full 2-year ownership and use requirements, but who are selling their home due to a change in employment, health reasons, or what the IRS calls unforeseen circumstances. If you had to sell your home before meeting the full 2-year test because of a serious illness, a job relocation, or another qualifying unforeseen event, you may still be able to exclude a portion of your gain proportional to how much of the 2-year requirement you did meet. This partial exclusion is particularly relevant for retirees who may need to move quickly due to health issues or changes in their care needs. Now let us talk about some additional tax considerations that retirees need to keep in mind when selling their home in 2026. The net investment income tax, also known as the NIIT, is a 3.8% additional tax that applies to certain investment income for higher income taxpayers. The good news is that the amount excluded under the Section 121 home sale exclusion is also excluded from the NIIT calculation. However, any gain above the exclusion limit is potentially subject to this additional tax. For retirees with very high income from multiple sources, including Social Security, retirement account distributions, investment income, and a large home sale gain above the exclusion limit, proper tax planning before the sale is essential to minimize the overall tax impact. It is also worth noting that selling your home can affect other aspects of your retirement financial picture in ways that go beyond just the capital gains tax. A large lump sum from a home sale could temporarily push your income into a higher bracket in the year of the sale, which could affect the taxation of your Social Security benefits, your Medicare premium calculations under the income-related monthly adjustment amount known as IRMA, and your eligibility for certain income-tested programs. Working with a financial advisor and a tax professional before you sell is not just smart. It is essential for protecting your overall retirement financial plan. Here are the most important action steps you should take right now to make sure you are prepared to use the home sale tax exclusion correctly. First, gather all your records related to the original purchase of your home, including your closing documents and settlement statement. Second, compile records of every capital improvement you have made to your home over the years, because these increase your basis and reduce your taxable gain. Third, calculate how long you have owned and lived in your home as your primary residence to confirm you meet the 2-year ownership and use tests. Fourth, if you are planning to sell within the next year or two, consult a qualified tax professional or CPA to review your specific situation and help you plan the sale in the most tax-efficient way possible. Fifth, if you are a surviving spouse who is considering selling your home, make sure your tax advisor is fully aware of the stepped-up basis rules and the 2-year window for using the $500,000 exclusion. Here at SSA Benefits Alert, we are committed to bringing you the tax rules, benefit updates, and financial information that retired Americans need to protect their hard-earned money and make the most of their retirement years. The American Tax Code is full of provisions designed specifically to help retirees and seniors, but too many people miss out on these benefits simply because they did not know they existed. That is exactly why SSA Benefits Alert is here. If this video helped you understand the IRS home sale tax exclusion, please give it a thumbs up right now because it helps more retirees across America find this important information. Share this video with your spouse, your family members, your friends, and any retiree you know who owns a home, because this information could save them tens of thousands of dollars. Leave your questions in the comment section below, and I read every single comment and will do my very best to answer you. And if you have not yet subscribed to SSA Benefits Alert, please subscribe right now and tap the bell icon so you are always the first to know when we post a new video. This has been your complete guide to the IRS home sale tax rule that most retirees miss, right here on SSA Benefits Alert. Thank you so much for watching today. Stay informed, stay protected, and we will see you in the very next video. Take care of yourselves, everyone, and have a wonderful day.